We're back. Let's do Ask Annex in the studio. Matt Morsey, Director of Research, also a CFP, part of the investment team. Welcome.
Hey, Danny.
We got Fred Coleman, a CFP and a wealth manager at Annex Wealth Management. Hey.
Hey, Danny.
Question number one on Ask Annex. I got 2 years to go before retiring. I currently contribute to our company 401k and my HSA. My idea is to reduce my 401k contribution to only enough to receive the match, but to invest the excess in my HSA while I can still do that. Same amount monthly, but in different places. The HSA is invested in a TDF, which is Target Date Fund, not Tour de France.
That's correct.
As a cyclist, yeah. Okay. What do you guys think of that?
I think you're right on the money where you absolutely want to first get that match. That's usually the number one priority. You can't pass up free money. But it also depends on where the next dollar goes, depends on your age and how much you have for retirement. We know that HSAs are beneficial. It's one of the most tax advantaged buckets. And if you're over 65, that's why I went to the age. If you're over 65, you can access HSA funds, even if they aren't necessarily for medical expenses. A big thing that we talk about all the time is tax diversification. So this question will be answered by how much do you have in your pre-tax? How much do you have in your after-tax? How much do you have in your taxable buckets? Looking at all those different buckets, that would help us determine, should we put more in the HSA? Should we maybe go more into a Roth IRA, or should we go pre-tax?
But if he gets on Medicare, he can no longer contribute to the HSA.
That's correct.
So maybe that's why he's piling it up?
That's correct. So once you're on Medicare, HSAs and Medicare don't mix. So that's one way to think about it. However, if you're not on Medicare, building up that bucket, even if you have expenses from the past, we know that at some point we are going to have some healthcare expenses, and you also can use that HSA bucket for Medicare premiums.
Yeah, and that's certainly, when you think from a healthcare standpoint, the most unexpected expenses that you're going to have, right? Everyone knows they're going to have something, but how early, how much, what are the different problems you're going to have? So having some ability to pull funds in a tax advantage way is really helpful there. I do also, really appreciate, Fred, you're going through the thought process of what does their financial plan look like? What are the different buckets that they have assets in already? But that kind of thought process of, okay, I'm going to get my match. Now I'm going to look for other ways that I can improve my financial situation and give me more options later on in life, I think is really impactful. The HSA is triple tax advantage. So you're maintaining that tax break that you would have had with a traditional 401k by having that deductible right away. But then you get the tax-free growth along with being able to pull that money out tax-free for health. And like you mentioned, that 65 age is so key, because then at that point, it's just another bucket of money. And if you really want, or need to spend it on normal retirement money, well, then great. Just pull it out of that HSA and you're good to go.
Question 2 on Ask Annex. I think a mom wrote this. I can't tell for sure. My son and his wife are millennials and desperately want to buy a home. So much that they plan on taking funds from their retirement accounts. I think it's a horrible idea. They're both high earners. They believe real estate will appreciate by as much, if not more, than that they would have made in the stock market.
Yeah, I think you're always looking at, okay, where are different sources of funds going to be coming from, and then what's that rate of return? So if they're looking at it from an investment standpoint, then you have to narrow down to that range, right? So from today going forward, what will appreciate more, a home or the stock market? Now, generally, you're going to be looking at stocks as a higher potential reward activity, but because you're taking more risk, and risk and reward are so closely determined to each other. With a house, you still have the house. They're much less risky of an investment from that standpoint, because you still have that collateral where a company can go out of business, and that's why you have that chance for outsized returns. Looking backwards now, that also makes sense from previous returns. Real estate generally goes up around the levels that our inflation are. The last few years have been a little bit different, so there might be a little bit of recency bias with this question as well, too, from a standpoint of very low supply, very high demand for homes, extremely, extremely low interest rates for mortgages, spurred the housing market to spots that we really hadn't seen before. And that seems great. And I think people try to extrapolate that going forward, but it likely, probably not. Stocks, we can't predict exactly what they're going to return, but we have a pretty long history of knowing that, your rate of return is going to be higher on there. And then the other thing I think of too, with this question, if they're both high earners and they're millennials, so which I would fit into that age group as well too, you're pre-retirement in both cases. So you're looking at a standpoint of, if I pull money out of a retirement account, I'm likely going to have to pay taxes on that money, and I'm going to have a penalty that I'm going to take out as well too. So when you look at it from a rate of return standpoint, you have to beat both of those things, the penalty, the taxes, and the price appreciation on stocks, to say that it was a better idea.
What's our wealth manager say?
you're putting yourself 20 to 40% behind right away because of the taxes plus the 10% penalty. So I would use a 401k and retirement assets as really the last resort. As a co-millennial, I can understand the need to want to get in the home, especially, the way the market's been flying over these past few years. But when you look at a plan, let's say you withdraw $50,000 from a retirement account, it's not going to be dollar for dollar in the future. You could be talking about hundreds of $1,000s in the future. So it's really important to sit down and set up a plan. Even if it takes maybe an extra year or two to buy a house, I wouldn't touch that retirement account.
2 millennials, 1 boomer on Ask Annex. Fred Coleman, CFP Wealth Manager. Thank you.
Thank you.
Matt Morsey, Director of Research, CFP. Thank you.
Thank you.